Hi, everyone. Welcome back to the Current Temp with Joey Solopek and, of course, my guest, Bill Gerner. First and foremost, Lexus of Memphis. Boom, shakalaka. We love them. Great product. Great men and women. Go tell them you saw Joey and Bill and ask them for a test drive, and they are going to take care of you. And, of course, Bill Gerner, one of our partners and our senior manager at EMC Equity Management Company. Bill, this is sort of what we've been working towards for the last 3 episodes. How to invest and what does that mean for risk reward? We've been talking about risk reward. So let me start with a very general question for you, because a lot of people don't understand the stock market. Why do you have to accept any risk at all?
Because of inflation, and because when you purchase groceries and gas as they go up, if your investment doesn't go up accordingly with that, then you're behind the 8 ball. You're behind.
I think we also ought to underscore that a lot of people come into investing thinking, well, I just need one magic stock. Why just give me the one great stock, and if it does great, I'm great. And they seem to have that mindset. I don't know that they understand when you invest, you have to decide how much risk you want and what that means for your reward.
That's right. But when you buy one stock, if you buy it near the bottom and it goes straight up, you did pretty well. But a lot of individuals will buy that stock at the top, not at the bottom. And so if you're not diversified and you don't get it right, that's a two-edged sword. You get hurt pretty
Okay. You just said
much.
something key, and we're going to talk about that. It's called diversification. So one of the things we want to make sure you understand is that risk and reward go hand in hand. They move together. If you don't take risk, you're not going to get the opportunity for reward. If you take a lot of risk, you've got the opportunity for a bigger reward and everything in between. So that leads us to this, and this is something I know that you have worked on for 30, 40 years or more. It's called asset allocation. And asset allocation basically means, what am I investing my money into? So why is that important?
It's very important because it has the most impact of anything is how much money you have in stocks and bonds and cash and alternative investments, private equity, whatever it may be.
Okay, so let's dive into that. Perfect lead in. You're reading my mind. So when you're investing, you've got options. Where to put your assets, how you're going to allocate it. That's what that first graphic meant. Some of your options are things like stocks, which are equities. Stocks and equities are the same thing. Bonds, which are more conservative, and sometimes that's called fixed income. Or cash, or something like the money market that gives you a very mild amount. Okay, I'll tell you what. With that in mind, let's get to one of our 2 more important charts, okay? This is called our risk-reward chart. Bill and I and our team talk about this all the time, and I'm going to break it down. Then we're going to ask Bill which is the best quadrant. What you're looking at is low to high in the middle. This arrow is your reward. Low reward here at the bottom, going up. And then the side arrow is your risk. Low risk on the left to high risk. So, Bill, this is a famous quadrant. What's the quadrant the investor wants to be in?
Money managers want to be in the northwest quadrant, and the reason being you have low risk and high return. In the crosshairs here, you have the broad market or the S&P. So in order to get the S&P return, you take this much risk and you get, this much risk and you get this much return. So we want to outperform the broad market, and we want to take as low a risk as possible. This is where we want to be. If you're down here and you're in the stock market, then you took low risk, but you don't get the reward. And if you're in, I guess, the east-west quadrant, you don't want to be way over there on the risk side and get the return because you're taking high risk, you're being speculative, and that's pretty dangerous. So, and you don't want to be down here, low reward, high risk for sure.
Red is bad. All right, let me recap. That was a great explanation. When we're looking at a chart like this, it's when we're trying to decide on how to allocate people's money or decide where they are on that risk-reward chart. And so as Bill just said, when it comes to your return, going up and down, high, or your risk, where do you want to be when you're choosing those vehicles we just mentioned, stocks or bonds or cash or whatever else there is? The northwest quadrant, as Bill said, is the sweet spot because it's the low risk, high reward if you pick your vehicles there. And of course, some gamblers want to go here, high reward, high risk. This is the worst place to be in red. And low reward, low risk means you're not really going to have a chance to do anything.
Well, there's another thing. If you are in the northwest quadrant, that's great, but you really have to work hard to stay there.
Okay, explain that.
Because your portfolio, there's always a regression to the mean. So if your portfolio is there, and after a period of time, you need to refresh that portfolio and get it ready for what's coming and be ready to stay there.
Which is a great place for me to say this, friends. What we're talking about is how to build your portfolio. Of course, everybody who's new to this may be going, well, this is a dumb question. Of course, I want low risk and high reward. What we're saying is, as you're building your strategy, that's what our goal is for most people. We want to control your risk and try to get you a high return by picking certain things. And as Bill just said, it's tough to stay in that quadrant because the main marker here is the S&P 500 or the index that we use. All right, here's the second most important chart. And let's spend a minute on this one. This is history. This is really a very interesting. We were talking about different vehicles and how you're going to allocate your money. Well, these are how the allocations have done over 25 years. This is our risk reward chart, and your return is going, let's see, up and down. Here's our return. So if the higher it is, the better the return. And going east to west, it's how much risk you've taken, or what's called standard deviation. So here's an example. Right here at the nexus, where we see both these lines coming together, your 3-month T-bill, a treasury bill, or a bond has had the lowest risk, but also the lowest return. So if you decided, I just want to make a very small return, but I don't want much risk, for 25 years, that's where you want to be. But if you go out, this green one, which says MSCI, which basically means international stocks, now we're getting more risk. The farther you go to the right, the more risk, but it doesn't have as much return as the Russell 2000 and the S&P 500, the index, which we use as a benchmark. So just at a glance, what this tells you is you've got the best return from the S&P 500, even more risk in the Russell, but not as good of a return. And international doesn't have the return, but it's still in that same risk category. But then you've got low risk over here. Listen, you've been doing this for a long time. What are your thoughts on this?
I have a lot of thoughts, but I'll keep it brief. But if you look at the zero return right here at the crosshairs, this is 3-month T-bills and money markets. And what happened in the bonds? So if you were in bonds for 25 years, you probably haven't kept up with inflation.
You're barely making under 5%.
Yeah, but
Okay.
here's the reason for that. That I believe this. I think people don't want to feel like they're losers. When you're in stocks, you do have ups and downs. You do have periods, but the main thing in stocks is the time period. If you want high returns, you're definitely going to have to put up with uncertainty, and you're going to have to be patient. So you may not get that return in 1 year for sure, but over 5, 10, 15, 20, and 25 years, you are going to get the return. And that's the reason people should not expect that in 1 year. It may happen, but more than likely, if your time horizon is not longer term, then stocks are probably not the place for you.
All right, it's like you're reading my mind, because here's our final note. So when you're trying to decide where you should be on that chart, in other words, what is your allocation when you're investing, things that Bill and I and our team decide for our clients all the time. You got to look at your time horizon that Bill just mentioned. You need to know your risk tolerance. How much are you willing to handle that volatility, and really what your long-term goal is. I had a client today I met with. His goal right now is he just wants 3 or 4%. He doesn't want any volatility. He's got reasons for that. He's got a business that needs a lot of fluidity and a lot of liquidity. His goal is just a very small return, and so we're controlling his risk. These are things you've got to factor in, and really, as we meet with clients, to me, this is the most important thing we have to discern to meet that client where they are. What is their time horizon? How do they feel or know about the market, and what are they trying to achieve?
Sometimes we can meet them, but sometimes we can't. What I mean by that is they'll come in and look you in the eye and say, I want to be in the stock market. The ups and downs don't bother me. And then when it goes down 10, 15, 20%, then your phone rings, and that's not a place for them to be.
Right.
Because they cannot take that. But if you can go long term and think long term and not short term, you will be rewarded. And people have to be patient, because stocks just don't go straight up. There is a down period that you have to deal with.
All right, and I want to close with this because we've covered a lot in this episode. Every investor is different. Every single one of you. We're talking about general guidelines here. So these are not specific instructions for everybody because each person out there has a different mindset, position in life, situation that will dictate how you need to invest. So keep that in mind. We also, nobody knows what the market's going to do in the future. Now, we all make bets and determinations, but there's no way to determine and tell anybody, here's what's going to happen. So keep that in mind. That's the famous phrase that past performance is no guarantee of future results. Having said all that, Bill and I and our team is called Equity Management Company. You know the website, it's emctn.com. So that's like Equity Management Company of Tennessee, emctn.com. You can contact us there and ask any question that you'd like. We covered a lot. Any final thoughts here?
Yeah, I have a couple. When you bring people in, not everyone understands markets and how they work.
Right.
But as they come in, and if they don't know much about the market, they're somewhat intimidated, and we have to loosen them up to where we can get them to talk and figure out where they are. But it's very important to educate people and to train them what goes on in the market. So if we bring them in several times a year, and the more we talk to them, the more they learn. And we have seen that pay dividends because people get comfortable. They don't panic when the market goes down. And the other thing we do know about people is that when they go to a party or they talk to someone, if you are in a down market, if the market is down and they're in these short bonds or money markets or treasury bills, they say, well, I didn't go down. But yet they're losing money.
Right.
And, you know, it's and nobody, as I said a while ago, nobody wants to feel like a loser. But these people are going to lose. They may win on the short term, but in the long term, they're going to really lose. They're not going to outperform inflation.
Yeah, if they're not having the right exposure. Friends, to Bill's point, we firmly believe that educating people as we go along is critical. If you're not getting that, you should be. And also make sure that you've got an advisor that you trust or has some great recommendations, because it's one of the most important decisions anybody ever deals with is how to handle their money. There is a trust issue out there. People come in not understanding the market, and I think a lot of them want to be educated as they go along. That's what we've seen.
I think they do, and I think we do a good job of that because it's just like the Bible. People read the Bible, but you need Bible literacy.
Right.
And you need market literacy too, and that's one thing we do is teach them. But it's kind of fun because you see each time you meet them, the more they learn, the more comfortable they are. And that pays off. You got to, as we said, you got to think longer term, not year to year as 3 months, and you're going to make a fortune in the stock market. You got to be diversified. You've got to know the market. You got to have a diversified portfolio and eliminate some of that risk. And you've got to be patient.
Friends, this was a good one. We went a little longer than normal, but there was a lot of meat on the bone on this one. I hope that this is starting to land for you and that you're tracking along with us. But we're covering a lot. We covered a lot very quickly. So if you have any questions, you can email us, thecurrenttemp@gmail.com, or go to our website, EMC, for Equity Management Company, just like Einstein said, EMC square. Go to emctn.com, and you can send us a note or ask us a question. We want to help educate you as well. No price for that. We're not going to charge you. We just like to have conversations, and if we can steer you in the right direction, we're going to do that. Any closing thoughts?
Well, one, and I'll open up a can of worms real quick, but institutions that have retirement funds or 401k funds, they do train their employees and they give them resources. And they know if you have a defined benefit plan that they have to meet those liabilities.
Right. Like
individuals, that's right. I mean, for FedEx, we had to earn enough to pay the pension benefits and then some. But individuals don't have the luxury of having the consultants and the people with knowledge to do that. But we're here to help, and we love doing it.
That's why it matters. Money matters. Boom. All right, friends. We're glad that you're here with us. This gave me a great idea for next week's episode. We're going to talk about the market and its history to help educate you as we go forward, and we hope that you have a great week.